Good afternoon, everybody, and welcome to a special webinar that we're doing today to talk about the budget. We promise to keep it to only 20 minutes. We've got a long weekend here up and coming. Hope everyone's excited to see hopefully some family, some friends over Easter. So let's get right into it. You will see in front of you Mehul's shining face and not Amanda Doucette's. Unfortunately, about 5 minutes after we sent out the invitation today with a reminder email about today's webinar, we received an email from Amanda saying that she had come down with COVID and was rapidly feeling worse and worse. And so she apologized that she can't be here today. Instead, we're excited to have Mehul. Some of you may have met Mehul already. I've been working with Mehul for about 2 years, helping us out on work with a lot of our business owner clients and some more complex insurance needs that we have in our practice. Mehul is a financial planner and an avowed tax nerd. And so we have asked him here today to talk a little bit about what the new budget means and how that will affect most of you or most of us as Canadians. So quick disclaimer to get things going today. Westmount Wealth Management is a registered portfolio manager in BC, Alberta, and Ontario. The content in our presentation today is current, and we believe it to be accurate as of today, and we currently have no plans to update it. As portfolio managers and financial planners, we offer advice around money management. However, we're not tax expert, and this is not personalized financial planning advice. Please consult your accountant, financial planner, tax, investment, financial planner. Well, say it again. Financial planners for tax, investment, or planning advice tailored to your situation. Okay, now that our compliance officer is pleased with our disclosures, let's get right into it. Joe, do you want to lead us into today's presentation?
So again, the budget document, it's over 300 pages long. We're really just trying to break this down into some, I guess, 4 key areas that we think are, most likely going to be most impactful to our clients. So let's get right into it. The question everyone wants to know, Mehul, are income tax rates going up?
That is the big question. Thanks for the intro, Lorenzo. I don't know if they can see my shiny face, but certainly my shiny head. Are income taxes going up? That was the big question going into the federal budget this year. Really, any budget that in the anticipatory stages, we want to know, are they going to go up? And the short answer is no, it's not going up. And that is a good news, obviously, to Canadians. What were we actually anticipating? Were there going to be changes to personal tax rates or tax brackets? No, there aren't. Okay, so no effective change to tax rates. However, with respect to tax rates, Minister Freeland did make a comment on the fact that just making everyone aware that the top 0.5% of income earners in Canada are paying, lower tax than she feels comfortable with. So is that a sign of things to come? Potentially, we'll have to see where that goes. The other thing, the other piece here, more specific to business owners, is the small business deduction rate. Now, as some of you might know, is that the first $500,000 of business income in a Canadian-controlled private corporation, or a CCPC, as we like to call it here in the tax world, the first $500,000 of that kind of income is taxed at the low rate of 11%. And then any income earned over 500,000 is taxed at the general rate of approximately 26% here in BC when we take into account the federal rate. There is no change to that. There's not going to be any change to the limit, the threshold of the 500,000, nor is there going to be a change to the rate itself. Great news for small business owners, incorporated professionals here in Canada. And then finally, the one that I particularly was looking at the closest and that kind of got me a little bit nervous was this capital gains inclusion rate. So we'll back up here, a little bit of a history on capital gains. Initially, when the income tax, the first iteration of the income tax came out back in 1917, there was no taxation on capital gains at all. And it wasn't until about 1972, I believe, that the first time capital gains was taxed. And that tax rate has moved anywhere from 50% to 75%. Currently, it sits at 50%. It has for the longest time, and there were some rumblings that this capital gains inclusion rate was going to increase to somewhere in the neighborhood of 67 or even 75%. What does that mean? It means whenever you sell a piece of capital property in Canada, be it real estate, be it a portfolio or a stock, you've hopefully realized some type of gain or an increase in the value. So you bought a house for 500,000, you sold it for $1 million. There's a $500,000 gain. The inclusion rate of 50% means that only 50% of that gain is taxable as income. The other 50% is not taxable. That rate is not changing. Very good news for Canadians, and personally, I'm happy about that.
Perfect. Excellent. So moving on, we have a new registered plan that's been announced. Mehul, do you want to tell us a little bit about the details of that plan?
Absolutely. This is the first registered plan in a long time, since 2009, since that TFSA came out. And so who is this guy in the middle, this FHSA that we're looking at? Well, it's kind of, I like to think of it as a combination between the tax-free savings account and our RSP. Now, at this point, I think we're all familiar with those two accounts. So let me do a little bit of a rundown on some of the rules here. First off, I think it's important to talk about where this fits in around the general theme that I noticed in this year's budget, which is the housing market. How do we cool the housing market? How do we address what's happening, especially in the major cities in Canada? And one of the big things that we hear about in the media a lot is young Canadians, first-time homebuyers are finding it very difficult to enter the market. And so we've seen a few things that we'll actually, a couple of which we'll address today, that are specifically geared towards these issues in the housing market, or this theme of housing. And this is the first one here. So it's a registered account with the purpose of making it easier for Canadians to save to buy their first home. So think of this registered account. Something's got to go in and then money's got to come out. The money that's going in is tax deductible. That seems familiar, right? That's just like an RSP. Every dollar you put in, you get to reduce your taxable income by $1. That's great. Essentially, we're taking our income, we're taking our pre-tax income and being able to use it as a down payment. The next part here is, okay, so we've got the tax deductible contributions. How much can we really put in there? We can actually put in up to $8,000 a year starting next year, 2023, and a lifetime maximum of $40,000. Now, one of the questions I get asked, or I was asked recently, was, well, what if I don't put in the full $8,000 in a given year? Can I carry that over to the next year, just like we can with the RRSP and the TFSA? In this case, you cannot. It's a use it or lose it type of situation. Put in your $8,000 in that year, or it's gone. Next year, you start with the new $8,000. So I hope that makes sense, and we can see that comparison there between the two other registered accounts. And then, okay, so there you go. That point's already addressed. And then what happens while the money's sitting in there? Of course, it's going to be invested. Hopefully, it's growing. And is there any taxation on that growth? No, just like all the other registered accounts in Canada. While that money is inside that account, in that registered account, the growth is not being taxed, or the income is not being taxed while it's in there. But then that begs the question, what happens when we actually need to use that money? First off, how are we allowed to access this money, under what circumstances, and what are the tax ramifications of using that money? Well, I'm happy to say that there is no taxation on the withdrawals. So that seems familiar too, right? That's kind of like the TFSA. When you pull money out, you're not being taxed on that as income. You're not being taxed on the growth portion. It's completely a tax-free withdrawal. How do you take it out? What needs to happen in order for you to be able to take this out? Of course, you need to be buying a home for the first time. What actually deems as a first-time home buyer? It's the classic definition of a home buyer or first-time home buyer in the Income Tax Act, and that is having owned a home in the last 5 years, not currently in a home that you've purchased. Now, the one thing I'll say about this is we're probably around 90%, maybe 85% of the full picture of this FHSA. We rushed to get it to market, so to speak, in time for the budget. We fleshed out the major points of this and how it works, the ins and outs and the workings. It does not come into effect till 2023, as we mentioned. So we have some time to get all the nitty-gritty details. What typically happens at a point like this is the tax community will go and scrutinize it. They will come up with questions, what about this? What about that scenario? What if this happens? Can you do this? Can you do that? Transfers and things like that. This is really these answers will come to fruition in the next few months, and definitely we will have the complete picture on this FHSA well before January 2023. Let's move on to actually, one of the things I will mention about this, which I found kind of interesting, is transfers. There was a little bit of there was a note made here about what if I never end up using this account to buy a home? Do I lose the money? You can actually, it appears though, right now that it will be eligible to transfer to your RRSP, and it doesn't impact your contribution room or contribution limit. So that's pretty forgiving. It's pretty broad. It's pretty flexible. I like that. I like seeing that. And we'll see how popular this account is for Canadians. The other thing is, we are aware with the RRSP, there is this thing called the home buyers plan. I'm sure a lot of you have used it, or your kids have. It is noted as of now, the rules state that you cannot use the home buyers plan and this FHSA in the same year for the same purchase. So a little bit of restriction there. I hope that changes. We'll see what comes down the pipe with that when it's all fleshed out.
Perfect.
Yeah.
Okay, so next, again, Mehul, you'd mentioned earlier that kind of one of the focuses on the budget was, again, housing in Canada, trying to make housing more affordable. And I guess our next point here is on talking about some of the, I guess, problems that have been perceived by the government and Canada Revenue with regard to the sale of property. So could you tell us a little bit about the new deeming rules on the sale of property?
Absolutely. So what we're referring to here is more commonly known as flipping, or flipping of real estate. So this can either pertain to your principal residence, which of course carries a big tax advantage with the principal residence exemption. When you sell your principal residence, you are not taxed on the gain at all. Or if you're selling an investment property, where there would be a capital gain on any increase in the value of that property when you sell it. What we typically have seen is that, of course, there's a tax advantage when you sell a principal residence. Of course, you're not paying tax on the gain at all. But there's also an advantage when you sell an investment property because it is treated as a capital gain. And remember, only 50% of that gain is included in your taxable income. The other 50% is tax-free. So over the years, especially in some of the hot real estate markets that we, like the ones we happen to live in, we have been seeing some Canadians take advantage of these preferential tax rules for selling residential property or real estate property and buying and selling in a very short period of time. Now, if you remember, in a few years ago, CRA or Finance made it mandatory that Canadians had to disclose any property they sold, including their principal residence. I sold my home last year, and when I did my tax returns for 2021, I had to provide a whole bunch of information to my tax accountant about the sale of that property, even though it was a principal residence and there was no tax due on that gain. So what I'm trying to say here is the government has kind of been gathering this data over the years to really try and assess to what extent this flipping is going on. What is the, I guess, advantage that Canadians are gaining, or perhaps the tax disadvantage that the CRA is missing out on through all these sales, these quick sales within 12 months. And here we have the rule around it. Okay, so what does this rule say? If you're selling any type of residential property for owned less than 12 months for a gain, it's going to be considered business income, which means you're not going to take advantage of the principal residence exemption or the capital gains preferential tax treatment. So that 50% inclusion rate, it's going to be treated as straight business income. You buy a property for $200,000, you sell it for $400,000, all $200,000 will be taxable as business income. Now, obviously, there's going to be all sorts of questions around, well, hey, listen, what if it was unavoidable? What if circumstances in my life made it that I had to sell that property? Thankfully, there are some exceptions under special circumstances. For example, a death of an individual, whether maybe you had a new child or a parent moving in, so you needed to upgrade the size of your home, or relocation because of work. There's some very prudent exceptions here and reasonable exceptions, I think, that will allow everything to be fair for Canadians with respect to this rule. But we kind of saw this coming down the pipe, this anti-flipping, or to sort of curb this. And again, overall, this working around this theme of cooling the housing market, trying to rein it back in, and in the sort of paraphrasing Minister Freeland, making it things more fair for all Canadians with respect to the housing market.
Perfect. And then our final fourth point we want to cover was personal tax credits. So Mehul, I understand there's a new one and then there's a change to an existing one. So I'll let you take it away and go over those changes.
Yeah, so there is two credits that we're going to talk about. There was a whole slew of new credits that were included in the budget. These are the two I think most important or significant ones. It's not uncommon for a budget to have what we call these boutique credits. Some of them are actually trying to fix or provide advantage to generally to Canadians or to specific subgroup, and some of them are political in nature, if I could say that. But in this case, I think these are two great things. Again, going around this theme of housing, this increase to the first-time home buyers credit or home buyers credit, the HBTC, I think we're calling it today. This credit increases from $5,000 to $10,000. What does that mean? Well, really effectively, it's a tax savings of $1,500 versus the $750 that exists today. So, or previously. So this goes into effect right away if you're purchasing a home. Every kind of dollar helps towards first-time home buyers, as you can imagine. And so I was happy to see something like this. Can a bit more be done? I guess it can, but given the climate we're coming out of with out of the pandemic and with the economy kind of being shut down or at least grinding to a pretty slow pace for a number of months or even years, this is something, and I think it's trending in the right direction. Definitely, we can see from this that housing affordability is on top of mind for the federal government. And finally, last point here that I'll talk about here is this multi-generational home renovation tax credit. No schnazzy acronym for this yet, but I'm sure we'll come up with one because we love doing that. What are we talking about here? Again, in the theme of housing, this is a refundable tax credit of up to $50,000. And so really, we are looking at up to a $7,500 in tax savings or refundable taxes for individuals who are adding a secondary dwelling or a suite in your home to accommodate one of two things. So either a senior family member or a family member over the age of 17 with a disability. Now, the one thing I will mention, which I think is very important, is that the definition of family member is extended or expanded in this instance, which I was very happy to see. Typically in the ITA, when we see family member, we're talking about children, whether biological or adopted, parents, and in some cases, grandkids. Here, we're also looking at aunts and uncles, nephews and nieces. So this is a nice tax credit for individuals who are in a position that they want to expand the size of their home, add a second unit. Now, these have to be eligible expenses. If you're looking to add a charging station in your garage for your Tesla, that's probably not an eligible expense that's going to qualify under this particular tax credit. There's other ones for that, but it is quite broad when we're looking at adding this secondary dwelling to your unit to accommodate these new family members that are joining you. So yeah, that's the high sort of level in the budget. Those are the big changes that I saw were sort of affecting most Canadians and the clients.
And we did it in 18 minutes. Oh, it just changed to 19 minutes, as promised. I hope that